You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob, and welcome to the new year.
Well, welcome to both. Yeah, it's good to be looking out at things, and it's the time of year where in our investment industry there's let's call it a peculiar compulsion to come out with forecasts for what different price items will be at the end of this year, 2015. Let's get used to saying it, 2015. And they're going to estimate what the level of the S&P will be at, and what the rate of GDP will be at, and what various interest rates will be at, long rates, short rates, and what the Fed funds rate will be at. And, it'll have nothing to do with what happens in between. And we are, and have been, and will continue to be, in very volatile financial markets. So, somewhere, I think let's put this one under bureaucratic ritual. But we're not going to do that here. What we're looking at here is, you've had the game going on whereby through the last number of months it's been hard sell-off in precious metals. Yep, we're going to start with precious metals here. And you've had a lot of joy in the stock markets and in the, until recently, bond markets. So that opposite effect, and gosh, that's been on for, it shows up in history going way back, where you can have, I remember back in the 60s, you'd have a good day in New York and in the Toronto Industrials, that's what we used to call them then. And you didn't have a bad day in the TSE Golds, they'd be down. So I remember once asking a trader about it, and he said, well, that's the way it works. And then for a decade or so it seemed to go away, but here we're coming back into this, where since the really big important high in the gold sector was in 2011, and it was a very speculative high, and our indicator, which we use, is the silver-gold ratio, and then the momentum on that one, which is the RSI. And it got up to 92, which was the highest it had been since January of 1980 at the height of that huge bubble. So that said, the best is in. Then in September 2012, there was another run at it, and then on that one, I think the RSI got up to a bit above 80, and anything above 78 shows that there's very dangerous speculation going on. And the last one we had was in May of last year. I think it was up to 82 on that one as well. So that was one, we had the nice rally out of Christmas. But you have a seasonal in here for gold, say a low in November and then a test in December into early January, and that looks like it's working out. And you've also had the plague for many people of extremely weak energy prices, with crude oil dropping from 107 last June, July, down to into the 50s here. And we had the trifecta of fundamental reasons on that going on, which was that crude oil could take on the pricing decline that natural gas had done a number of years ago. Then there was the geopolitical side, this time working against it, where it'd be of the world's interest to deprive Russian dictators and crazies in the Middle East of oil revenues, and that's been going on. And then you just have plain old seasonality here, where crude can often decline from late September, October, down into December or January. So then there was one other thing we had going here. We did this one quite a few months ago, where we counted out previous periods when you had a relentless bear market for crude oil. I mean, serious liquidity problems. And those crashes, let's call them a crash, would run for 6 or 7 months, and that counted out to December or January. So there's a whole number of things here saying, one, that crude oil you could settle low in here, but this is not for investors to roll in to say, hey, there's the start of something big and position, because this is going to take a number of months very severe, big swings and volatility and everything else before you finally set a bottom. So there's no need to rush in.
I've heard perhaps a bottom of $30.
You can pick, anybody can pick a number on it, and also a lot of technical things on this. Oversold, capitulations, been getting all those readings, but it's still going to take a long time to sort itself out. The collapse, a similarly politically beneficial collapse in late 85 into early 86 took the price from, well, the high had been, I think, around 35, and then going into the crash, it was around 31, and it ended at $10. But you can't apply that proportionality now. You just that it's been bad, and it'll take a long time to get sorted out. But within this, the moves today that we opened up and started talking about are kind of financial, where you've got an outside reversal going on for gold and silver and gold stocks, like they said. A lower low than the day before, and then so far they're setting a higher high, and then we want to wait and see what happens at the close. And then the same thing, some opposite going on in S&P, for example, where it started up and then it's down, and it's a bigger range than Friday's trading, or the previous day's trading range. So let's look at this part. We mentioned that you can have seasonal lows for gold in November, then a bounce up, and then a test of the lows in late December, early January, which we're getting now. Of course, these things are oversold. There's a cyclical one in here, which would have a low for gold in early in January, and then our ones that we were looking to provide us some guidance was that gold shares would begin to outperform the price of bullion. And it's been working on that, and that is also happening today. The other part of the recipe would be that silver would begin to outperform gold, and that's being worked on here today as well. So it's turning positive for the gold sector. I think there could be a good trade in here. And then a major test to make it, to confirm that this thing really is working on an uptrend. The other one that's interesting here is that we've liked the grain sector, the agricultural prices in that index is the GKX, and it has been doing very well, but the last few trading days it hasn't been doing so well, so I think maybe the best is in for that one. And but you're seeing no strength really in base metals. The base metal mining stocks, SPTM, they're still under pressure. Don't see any reason to get excited about that. So it looks to me like there's just the financial side, the interplay between gold and the stock market, and I think it's turning in gold's favor. And on this one can trade some the ETFs on the gold and on the silvers. We want to be in liquid ones. Those that like to trade the juniors, there's a number of us who you can't get out of those things when you've got them. You can get out of some of your position, but you'd have to know the story very well and be highly confident to start accumulating on that one then. But the first idea would be to trade some more of the liquid ETFs and GDXJ and things like that. So, and then with this today, you've got an extension of the bond rally. It's now, it's having a good day in bonds, not yet up to the high of a week or so ago, but the high-grade bond market is looking good, and when was it now? A few weeks ago, the pressure in the junk bonds, the JNK, was just horrendous, and it came down, and it actually registered a capitulation on the weekly basis, and so we got a terrific bounce on that. It was a capitulation plus a springboard action, and then now it's given the opposite on that. So we think that the action in junk bonds, lower grade securities, will be negative for the next while, and this would be also part of being negative for the stock market. So it looks like a very interesting start to the trading year, and hopefully we can be on top of a number of the trades that come up over the year.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet. for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to market historian Bob Hoye. How are Canadian banks doing in the financial situation? They told us a year ago they were in danger and it was time to get out of them. Has that proved to be true?
Well, they did exceptionally well, but they've come down with the liquidity problem in the oil sector. Let's just bring one up here. Yep, there they are. They had a very good high with the September high for a number of things. Sold off down into October, in the middle of October. That selling pressure there. Rebounded out to, I'm looking at Royal Bank here in U.S. funds. 75 was the high in September, down to 65. That's a hit. And then back up to 74 in late November. Then down to that 65 level again, and this time the rebound's up to 69 number of trading days ago, and that now is under the 200-day moving average, and it turned back away from it because it slipped off down to 68 and change here. It's going to be obvious that the Canadian banks were lending money to the oil patch, and the oil patch is in difficulty. And if you want a really good forecast on what's going to happen to many of the oil companies, just take a look at what's happened to a lot of the gold shares with that start in 2011. So this one, more or less, you can say the problems in the oil business really started last June, July, when the XLE, the ETF for oil stocks, got so overbought and done up. So now it's coming out. So and it reminds of a story when everybody, all the banks were getting into the oil play on the high in 1980. Oh yeah, that was great. And then there was a magnificent crash, and banking companies were doing very poorly in the States and in Canada. And so you're getting into the mid-'80s with weak oil prices, and they got so upset about it in the States that there was judicial hearings and stuff like that. And there was one young, formerly aggressive banker out of Oklahoma with a small bank who was fully into the oil play, and the judge asked him, well, where did the money, this is one of the things that happens when you get into a contraction, is where does the money go to? So naturally the judge asked this young banker, well, where did the money go? And he says, well, Your Honor, it went into wine, women, and song, and the rest we just pissed away. So that was reported in the Wall Street Journal, and it was a great one to read at the time. So this was years after the actual high, and was after when it really did do the crash. So the oil patch can stay bad for a while. I think that, again, there are going to be some oversolds and whatnot, and one can trade. But for the most of us ordinary investors, just stay away from it for a while yet.
Bob, well, thanks a lot for that report to start off the new year.
Always good to be with you, and we look forward to having a fun year. No matter which way the trades go, hopefully we can be on top of them.
Well, I'm still kicking balloons out of the house. So it must have been a good start to the year.
Very good.
Bob, thanks a lot again. My guest has been Bob Hoye. He's the Chief Investment Strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HoweStreet.com radio. Find us on Twitter at Talk Digital Net. You can also find us on YouTube on Talk Digital Network. Comments about the show can be sent to info@HoweStreet.com. I'm Jim Goddard.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.